Imagine you walk into a bank with $100 in cash. You hand it to the teller. The teller smiles, types something, and your money disappears behind the counter. Here is the strange part. That same $100 is about to be used in a way that makes it feel like more money exists than before. This is not a trick. This is not fraud. This is how modern money quietly comes into existence. But to understand it, we have to forget everything dramatic we imagine about banks. No vaults overflowing with gold. No secret printing machines hidden in basements. The story of money creation is much quieter than that. Banks exist because keeping money under a mattress is inconvenient. People want a safe place to store money and a way to move it around easily. So banks started as simple storage places. You give them money, they keep it safe. You come back later and take it out. But over time, something important changed. Banks noticed a pattern. Most people do not come back for all their money at the same time. On any normal day, only a small number of customers ask for cash. So banks ask a quiet question. What if we did not let all this money just sit here doing nothing? This leads us to the first simple idea. When you deposit money in a bank, the bank does not lock it away. It records a promise. Your bank balance is not a pile of cash with your name on it. It is the bank saying, "We owe you this amount." That promise is important because it allows the bank to use most of the money in the meantime. Suppose you deposit $100. The bank keeps a small part aside just in case you come back soon. The rest is lent to someone else. Now, something interesting happens. The person who borrowed the money spends it. The shop owner who receives it deposits it into their own bank. Suddenly, there are two people who think they have money. You see $100 in your account. The shop owner sees money in theirs. No new cash was printed, but the total amount of money people believe they have just increased. This is the second idea. Most money today is not physical cash. It is numbers in bank accounts. And banks create these numbers when they make loans. When a bank approves a loan, it does not go find existing money first. It simply adds numbers to an account. This feels backward. We usually imagine banks lending out money they already have. In reality, lending creates the money first, and deposits follow later. This is the quiet engine of the modern economy. But this system has limits. Banks cannot lend endlessly. They must keep enough money available to meet withdrawals. They must follow rules set by regulators, and they must believe the borrower will pay back the loan. When confidence is high, banks lend more. Money grows quickly. When confidence disappears, lending slows or stops. This brings us to the turning point. When too many people lose trust at the same time, problems begin. If everyone suddenly wants their money back, the promises cannot all be honored at once. This is what people mean when they talk about a bank run. The money was never really gone, but it was never fully there in the first place. Governments stepped in to stabilize this fragile system. They created central banks, deposit insurance, and emergency lending. These are safety nets designed to protect trust, because trust is the real foundation of modern money. Money works because we believe bank balances can be used tomorrow, not because they are backed by piles of cash today. This leads to a strange but important realization. Banks do not just move money around. They help create it quietly, daily, through ordinary loans. And that creation shapes how fast economies grow, how bubbles form, and how crashes spread. In the end, money is less like a physical object and more like a shared story we agree to believe. Key takeaways. Most money is created by banks when they issue loans. Bank deposits are promises, not stored piles of cash. Trust allows this system to function smoothly. When trust breaks, the system becomes fragile. The next time you check your bank balance, it may help to remember this. What you are seeing is not just money. It is a promise, a belief, and a system that works only as long as we all continue to trust it. Let us slow down and look closer at what happens after that realization. Because once you see money as a promise, the entire system starts to make more sense. Think about a simple village. Everyone knows everyone. If the baker trusts the farmer, the baker might give bread today and get paid next week. No coins move, but an exchange still happens. That trust creates temporary money. Modern banking does the same thing, just at a massive scale. When a bank gives a home loan, it is not handing over physical cash. It is creating a new promise. The borrower promises to repay over time. The bank promises that the numbers in the account can be used like real money. Those numbers are accepted by shops, companies, and other banks, so the promise becomes spendable. Now notice something important. As the borrower repays the loan, the opposite happens. Money quietly disappears. Each repayment reduces the loan balance. The numbers shrink. When the loan is fully paid off, the money that was created by that loan is gone. This means money is constantly being created and destroyed, not by governments printing notes every day, but by millions of ordinary loans being made and repaid. This is the third idea. Money in modern economies is elastic. It expands when people borrow and contracts when they pay back. This elasticity is powerful. It allows economies to grow when opportunities appear. New businesses form, homes are built, education is funded. But elasticity also creates risk. When banks lend too easily, money grows faster than the real economy. Prices rise. Assets like houses or stocks become expensive, not because they are more useful, but because more money is chasing them. This is how bubbles form. For a while, bubbles feel good. Everyone feels richer. Loans are easy. Confidence feeds on itself. Until something small breaks the story. Maybe borrowers stop paying back. Maybe prices stop rising. Maybe fear spreads faster than confidence. Suddenly, banks become cautious. They stop lending. And when lending stops, money creation stops too. This is why recessions feel like money is disappearing, because in a very real sense, it is. The same system that expands smoothly during good times contracts sharply during bad ones. This brings us to the role of central banks. Central banks do not directly create most money. Commercial banks do that through lending. Instead, central banks influence how easy or hard it is for banks to lend. They adjust interest rates, which is the price of borrowing. Lower rates make loans attractive. Higher rates make them expensive. By doing this, central banks try to manage trust and confidence. Not perfectly, but enough to prevent the system from swinging too wildly. They also act as lenders of last resort. When banks panic, central banks step in and provide temporary support. Not because banks are special, but because the collapse of trust spreads quickly to everyone else. This is often misunderstood. People ask why banks are rescued when they fail. The uncomfortable answer is that the system itself is being protected, not the banks. Because when the promise breaks, it breaks everywhere. Over time, this system has grown incredibly complex. Derivatives, shadow banking, digital payments. But underneath all of it, the core idea remains simple. Money is born from trust. Banks are trust factories, and loans are the machines inside them. This is why banking crises are never just financial events. They are psychological ones. They begin when people stop believing that tomorrow will look like today, and they end only when belief returns. Key takeaways. Bank loans create money, and repayments destroy it. Money grows and shrinks with confidence, not just policy. Bubbles form when money expands faster than real value. Central banks try to stabilize trust, not control every outcome. So the next time you hear that banks create money, it does not mean they print it out of thin air. It means they turn trust into numbers, and numbers into economic activity. Money is not a thing we hold. It is a story we keep telling each other. And as long as we keep believing it, the system continues to work.